Hi, and welcome back for episode 2 of Mortgage Matters with myself, James Burgess from Avocado Property, and Ryan from
RSN Financial Solutions.
There we go. Right, today we're going to go through a couple of audience questions, and Ryan's going to also do some myth busting with us as well surrounding myths on mortgages. Yeah?
Yeah.
Okay, let's get straight into it then. First myth we're going to answer is access to whole of market versus tied brokers. What does whole of market mean?
So these myths that we wanted to kind of touch base on, they hopefully will help clients to understand a bit more about the mortgage world and about how their finances work. Did you guys know that a whole of market broker, to become whole of market, what you need to do is provide clients with an option or a few options in each kind of category. So in total, you don't need many lenders on panel to be classed as whole of market.
Right.
That's very different across all the different mortgage brokers, right? So you could get mortgage brokers, in essence, that have access to 15 lenders, all the way up to mortgage brokers that have access to over 95 lenders.
So in effect, all of market doesn't actually mean all of market. It just means a proportion of market.
Exactly.
Yeah, okay.
So it's quite important to then, if you're a client and you're dealing with a mortgage broker, touch base with them to see how many lenders do you actually have access to. If you're over 85 or over 90, then you're likely to be able to get them the best rate or show them quite a few options to compare against.
Okay. So in essence, then, when you're going to a mortgage broker, they're not all the same. You need to really clarify with them just how many options they're going to be giving you and as to how many lenders come under their umbrella.
Exactly.
Yeah. Okay.
Because all of this then affects your rates, your monthly premiums, and to be honest, what mortgage you're going to get at the end. There might be limitations with some lenders. There might be limitations with some brokers. So quite a few instances where I've gained clients is because I can offer them a better rate than their current broker, or at the very least, I offer them the exact same rate because I have access to more than 95 lenders.
Ryan, next myth is that Ryan, next myth is that brokers have access to exclusive or semi-exclusive deals, touching base that some lenders only deal with brokers.
So this is true. There are some lenders like a BM Solutions or some bespoke lenders that only deal with mortgage intermediaries, like a broker like myself. What they do is they prefer to deal with brokers because they give brokers at certain rates, and there's certain levels of due diligence that brokers have to do on their behalf, on the client's behalf, to best understand the situation. Now, in terms of your kind of everyday high street banks, there aren't many differences in their rates. They don't have exclusive rates for brokers or the public. But what they do have is where a broker adds value there is understanding the criteria and all the other aspects, which we'll touch on in the next myth.
But you done my mortgage for me fairly recently, and when I inquired directly with the bank compared to what you got me a better rate.
Yes. Now, the reason why that is at the time where you're checking, or the time that the NatWest in this instance would send you an email with your rates, that was at a specific period of time.
Okay.
Whereas once you sign up with a broker will be able to check rates every week, every day even. And what I was able to do is I waited until NatWest dropped their rates, and then I was able to amend your rate over.
Okay, fair enough. Yeah, that makes sense. Yeah. Okay, so next one is the difference between switching lenders versus product transfers. How a broker can avoid or help avoid standard variable rate and the impact of acting early.
Okay, so in a situation like this, I would always recommend to clients to switch lenders if it's in their best interest to do so, right? So for example, if you're currently with NatWest and it is cheaper to move over to a Barclays, for example, then it makes viable sense for you to do so. If you're a pretty standard customer who's got all of your ducks in a row, per se, in terms of your employment, your credit score, everything about your situation is pretty straightforward and vanilla, then it makes sense to move over because you're saving money, right? And as the more money you save, the better it is. Now, there are obviously limitations and complexities with that, such as there are legal costs, valuation costs, and associated admin that you'd have to kind of go through. Now, where a broker can help avoid the standard variable rate is to be acting early. So a broker reaches out to their clients normally 6 months to 3 months before their mortgage is up for renewal. It normally takes, I would say, 4 weeks to 6 weeks to do a full remortgage. That means kind of doing the entire fact find with the client, the admin process, dealing with the lenders and switching your rate. Now, doing that always ahead of time, make sure that the remortgage is done on the same day that your current fixed rate ends, so that you're never paying the standard variable rate and in turn higher premiums.
So if you was to stick with a lender that you're currently with, is there less paperwork involved than if you was to switch that client to a new lender?
Yes, most definitely. So to stay with your current lender and do a product transfer, you pretty much don't have to do you don't have to do a valuation, you don't have to do a credit report, you don't have to provide much further information, because you've already got your mortgage established, for example, with NatWest in your situation, right?
Yeah.
So what I would be doing there is actively monitoring NatWest rates to make sure that they are still the best in the market, to make sure that they are still best suited to your needs, to make sure that I can amend it down as the rates come down closer to your fixed time.
The next one we've got is the pitfalls made without a broker, not understanding early repayment charges and doubling up on some of the extra charges that you might have.
So this is a common problem I see with so many clients, right? They stay with their lender, and when they need a little bit more money, they apply for a second part to their loan, a further advance. And what that does is it creates two parts to your mortgage, right? A part one is your main balance, and then part two, for example, if you're doing a refurb, you've taken out an extra X amount. Now, those two parts, when you take them out, they're at different times in your life, across your lifespan, and they won't be aligned. So what that means is part one of your mortgage might be renewing in February, part two of your mortgage might be renewing the next year in October. Now, each one carries a early repayment charge if you're in a fixed term. Also, what that does to the client, it kind of locks you in with that lender, because if you then find a better rate to move, because one part of your mortgage is up for renewal and it's cheaper to go to another lender, you then can't make that jump because you have to pay the early repayment charge on the second part. Right. So speaking to a broker ahead of time, it's perfect in this situation because it helps to plan. You can help to understand your situation. And what we try to do is we can try to align them to be similar. We could try to move one part over to a tracker so there's no early repayment charges. Or there are situations where you just keep one part on a variable rate just to make sure you avoid the early repayment charges. But a broker will help understand that in the cheapest possible way for the client.
And a lot of people would refinance on their mortgage at the time of renewal though, right? So because that's what I done. So although I had the separate points of the mortgage, they were at the same time. So when it come up for renewal, they were all up for renewal at the same time. That's what most people do though, right?
No, you'd be surprised. So I would think that that's the most common way to do it. I would say that's the most logical way to do it. But what people do is they often just take extra loan whenever they need it.
Midterm or
exactly, because you can take the loan out without incurring any early repayment charges because it's a second loan, right?
Yeah.
You're taking out almost a secondary mortgage on that same property, but it just makes your current mortgage bigger, but in two separate parts. Right. One part might be for your, I don't know, say 200K for your mortgage, and the second part might be an extra 100K to do your refurb.
Okay, the next one is about how brokers get the best deal for their clients.
Okay, so this is the most common question I get, right, from a client. Ryan, what's the best deal in the market? Now that the rates are below 4%, can you get me the best deal in the market? Now, not as we probably touched on in our first episode, not every client is the same, right? So understanding the client's situation, their credit situation, their income, their property in quite a few instances affects the rate that they're going to get. Their loan to value is a massive factor. Their deposit size is a massive factor when you're doing a purchase. All of these things affect the rate that you're going to get. So hearing someone say, I just want the cheapest rate in the market, it's never applicable. That's obviously what every broker is going to do. But the broker also has to understand all the other complexities, like having flexibility. Every situation is different. Some people don't want a fixed rate. They want to be flexible and not have any
maybe planning on moving in a few years.
Yeah. Some people have certain lending criteria that they need to be able to match. So for example, you might get clients that have a missed payment. You might get clients that are going for new build flats. You might get clients that are going for properties with a smaller lease. All of these aspects affect your lender that you go to, and therefore not every you can't just say I want the cheapest price across across the board.
They have to fit the criteria.
Exactly.
Okay.
Yeah.
Cool. Next one is around self-employed contractors or bad credit, generally dealing with non-standard cases.
Okay, so doing the standard vanilla case is a PAYE employee, right? Now, not that they are too dissimilar, but having a self-employed individual, a contractor, people on the CIS scheme, NHS staff, 0 hours contract staff. All of them have a different review from lenders. So they require different pieces of evidence. For example, self-employed, you need to have on average 2 years accounts, right? There are some lenders like a Halifax that will take 1 year of self-employed accounts. Contractors, it's about showing kind of a track record of payslips. So you have to have the last 12 weeks or the last 12 months in some lenders. And in terms of bad credit, it's a broker will help to understand your credit profile, right? And we'll be able to check kind of missed payments and match that up with criteria from lenders to see which lender will accept. Because there are nuances between every lenders, right? So a Santander won't accept more than 2 missed payments across a 24-month period. But a Halifax or a NatWest, they don't mind as long as your credit score in totality is strong. So it's just understanding these situations and then navigating those conversations with the client to make sure it's in this situation, NatWest and Halifax might not be the cheapest client. They might not be the cheapest lender, but they're the only lender that would accept the client.
And the criteria of the lenders will change from time to time as well, right?
Exactly. Yes.
So from your perspective, you have to make sure that you're up to date with all of the lenders' criteria all the time to understand what's best for the client.
Exactly. That's pretty much a lot of the training that we do, right? So a lot of my reading every Monday morning is to kind of review the lender's criteria, review what the current rates are, any rate changes, and how that affects my client base.
Okay, so if we now go on to the question and answers that we've had, or the audience questions rather, that we've had from online. The first one we've had is, I'm a first-time buyer with a deposit. Can I get a mortgage? It's pretty standard, right?
Yeah, so this is a standard situation. What I found from being a mortgage broker is that the understanding of clients for financial aspects is not as strong as not as strong as what I expected. So, for example, an engineer is very good at being an engineer, but they don't really understand the house purchasing process. So this is where coming to a broker is perfect, because I can handhold them through the entire process. This question is a pretty standard yes. Of course, you can get a mortgage. We will then go through your situation to understand what your credit situation is, your employment, what the property is you want to purchase, and we'll match that up with a lender that accepts your situation and then find the best possible rate with that lender.
Because of late, they've had some sort of first-time buyer initiative deals out there. I think there was one where it held off payments for 3 months, where you could sign up. I don't forget which lender it was, but you didn't make a payment for the first 3 months, which I thought was a good idea. And is there a return of 0%?
Yeah, so there's like April mortgages.
100% mortgages.
Yeah, they do 100% mortgages, but the criteria is always limiting, right? So with that lender in particular, they do a 10 and 15-year term,
right?
Which isn't going to work for quite a few lenders. It isn't going to work for quite a few clients, right? Because a client might want to only fix it for a certain amount of time. If the interest rate is higher, which it's bound to be, right? It doesn't make sense to fix for 15 years. Yes, it makes sense for the lender because it's a new product, but for the client, it might be you're out of pocket. So sometimes saying 100% mortgage is great, but what that really means is you're paying your deposit over more premiums every month.
Yeah. Okay, next one is, I'm on a fixed rate ending soon. Should I remortgage now or wait? We kind of covered that on one of the myths, but yeah.
Yeah, exactly. So I think in response to this one, I would reach out to a broker. If a broker hasn't, or if you don't already have one, reach out to a broker about 3 months before. Get them to review what current rates your current lender has, as well as what's in the market. If it's worthwhile moving, you'd have to decide financially if it's worthwhile to do the admin, the valuation report, and any associated legal costs, right? If it's worthwhile to make that jump, for example, I would make that jump if I was saving more than £1,000. I would definitely make that jump, because providing the admin is not that hard. To do the valuation, I'm quite sure it would be fine. And the legal side, you can get lenders that do free legals. So to make that jump, if I was saving £1,000, I would definitely think about it.
Okay, cool. And then the last one is, again, we've kind of similarly covered this already, is I'm self-employed. How many years of accounts do I need?
So, yep, we touched on it before. I think you need to have 2 years accounts, your last 2 years trading. You also need your last 2 years tax year overviews. So your tax calculations and tax year overviews are what lenders request. Some lenders will also request, or alternatively request, your accountant's certificate to plan your forecasted revenue going forward. And what that shows is how stable you are as a customer and what that then means for you to be able to afford your mortgage.
Okay, so last question is around buy-to-let mortgages and how the deposit can affect affordability.
Okay, so traditionally, a buy-to-let mortgage, you need 25% deposit. There are some lenders that will allow you to put in a 20% deposit, some maybe 15, but they're more bespoke and their rates are obviously going to be higher. But if we assume the standard 25% deposit, what that then means is the remainder of the property will be your affordability. So it's different to a residential mortgage. For a buy-to-let, what the lenders will do is they'll look at the rental property and how much rental income it gives. So when they go to do the valuation, they will go and check to see the value of the property and the rental income it provides. If the rental income meets 145% or 165% if you are a high rate taxpayer, if it meets that stress test, then they will give you the amount that you need.
Okay, because that's where I think a lot of buy-to-let guys have fallen down, where they've gone with a 25% deposit. They've had the property's met the valuation, but the rents haven't.
Exactly.
And therefore the amount has dropped on their mortgage. There was a period of time, there wasn't there, where they were really struggling with the stress test on those rents, and it was almost you needed a 50% deposit for those stress. What's changed there then? Has the stress tests come down?
The stress tests, no, they've pretty much stayed the same, but the lenders are a bit more relaxed, right? Okay. They're a bit more relaxed with the deposit levels, but I think that's come hand in hand with them being a bit more stringent on the valuations.
Okay.
So there are quite a few valuations now. If you have a flat or a leasehold property, there are quite a few stringent valuations coming back where they are valuing the property slightly lower than what an estate agent like yourself would value them as.
Okay.
So it's often important to understand an estate agent's valuation is how much you'd sell the property for, and a lender's valuation is how much you would sell the property for in a distressed scenario.
Yeah. Okay. Fine. So I think that's us wrapped up then. So another episode done of Mortgage Matters. Thank you for your time, Ryan.
No problem.
And we'll see you on the next episode.
Sounds good. Thank you, guys.